Welcome to our decoding of Union Budget 2026. From changes in sovereign gold bond taxation to higher STT impacting markets, there's a lot to understand. Joining us today are two experts. First, CA Chirag Chauhan, who will break down the personal finance and tax-related changes. And then Aashish P Sommaiyaa, CEO of WhiteOak Mutual Fund, to discuss what this budget means for markets, the economy, and sector opportunities. Let's begin. So Chirag, I have a few questions for you. I'll jump right in. What does the new buyback rule mean for taxpayers?
The buyback rule, previously what it used to be happen, the buyback rule government has changed couple of years before, in which the small shareholders, whatever the buyback price they pay, they have to pay, the full tax on it based on their slab rates. Now, the good change is now you have to pay as per capital gain. So if it is long-term capital gains, you will end up paying, 12.5 plus the surcharge. So it's a big positive win for the small shareholders, and they can have a good benefit out of it.
So earlier, did investors have to pay the tax only on the profit or the full amount?
They had to pay the tax on the full amount based on what your slab rates are. So imagine if a person is earning already 35 lakhs plus the whatever the buyback is, then the tax goes to as high as 35%. But right now, they have reclassified it as a capital gains, which used to be, the original provision. So this is much more beneficial for the small taxpayers. And still for the promoters, the old rule is applicable.
Okay, got it. So there also seems to be some changes in the SGB taxation. Could you help simplify that for our investors?
Yeah, the government is very smart enough to, shift the liability, what the gold price is as on today. But what they did is like whoever has purchased the original subscription directly from the RBI, if they are holding for the continuous 7 years long, then the tax is exempt for them. But the people who might have bought from the secondary market like exchanges or from the brokerage house or indirectly, for them it is not exempt. So they have to pay long-term capital gains. And even if you redeem in between before the maturity, you are liable to pay the long-term capital gains.
Okay. And this applies for those who bought before today as well?
Yes, everyone in all the tranche. So since the beginning of SGB till the year, it's applicable for everyone.
Okay, so if you purchased an SGB directly, then you're okay. But if you purchased it from secondary markets, then you will have to pay tax.
Yes.
Understood. So thirdly, Chirag, TCS on travel, education, and medical expenses abroad have been reduced to flat 2%, right? Please explain what this means for taxpayers and what do you think drove this change, to be included in the budget?
See, basically, a lot of the capital used to get blocked if the TCS was 10% or 20% in some cases. So what it used to happen that if you are traveling, you are spending 10-20 lakhs, then your 2 to 4 lakh rupees get stuck in unnecessarily for more than 1.5 years. So government was always aware about this provision. But what they wanted to check is to see that, what kind of tax outflows they are able to control, or, what kind of net effective tax liability would be. But what they have seen is like after every this exercise, that most of the time resulted in the huge refund from the government end. So government had to pay refund plus the interest. So it would become a more costlier affair for them. So realizing that, they have changed the rule. They have kept it now a flat 2%, which is very nominal, and I guess no one will mind paying 2% TCS.
Right.
And this rule has been changed even for education, medical, or even for travel. So all has been aligned to 2%, which makes easier for compliance as well.
So earlier it was a hassle for both the public and the government. So in order to tackle
Right.
that, I guess they have reduced it to a flat 2%, right?
2%. It's like a win-win situation.
Right. Anything else, Chirag, that taxpayers should know from Budget 2026?
There's one more big change that is in relation to lower TDS certificate. So whenever you used to apply for the lower TDS certificate, NRI or otherwise, the approval should come from assessing officer. So now they have changed the rule. The approval will come directly from the department. So there won't be any tax officer involvement into it.
Okay.
So it would be more easier. So at least the corruption level would reduce automatically, where you need not to interact with the tax officer, and entire thing would be handled online.
So number of middlemen is now reduced, which
Yes.
the whole.
Not the middleman, I would say the tax officer also used to ask so many paperwork and detail, and they might even call you multiple times.
Hmm.
Now everything, the process will shift online. So, you need to apply. It, it will have a standard checklist with the department. Any of the officer other than the assessing officer would, go through it and, give you the certificate without any human intervention.
Understood. That makes sense. Thank you so much, Chirag. Thank you so much for
Okay.
your time.
Thank you.
Markets seem to have given a thumbs down to the Union Budget 2026. To understand what this budget really means for the economy, markets, and sector opportunities ahead, I'm joined by Aashish Sommaiyaa, CEO of WhiteOak AMC, one of the most respected voices in Indian equities. So, Ashish, let's start with the big picture. Markets are more than 1% down following the speech from the finance minister. What are investors not liking about the budget?
See, I think, whatever one may say, I mean, say, for example, if you ask somebody 15 days back, they would have said that, there are low expectations. And they would have been all praise for the government saying that, okay, look, in the last 1 year, they've given tax benefits up to 12 lakhs of income. They've cut GST, right? We are about to come up with eighth pay commission. And, in every state election, there is some, the government has been boosting consumption by announcing some or the other kind of incentives. So 15 days back, people would have said that the government is doing great and we don't have much expectation. But unfailingly, what happens is in the run up to the election, there is some or the run up to the budget, some or the other kind of noise builds up. And then people start thinking that, oh, currency is depreciating, FIIs are selling, we should make our country more attractive. So, some expectation builds up, and then obviously that expectation is not met because after doing so many things, frankly, I never expected government to cut capital gains tax. Definitely, I have also been saying that when we compare India to other emerging markets, then we need to do something because our taxation is onerous. To be fair, if you look at capital markets, dividend taxes, we are consistently increasing capital gains. On top of capital gains, we have surcharge and cess, and then of course STT. And we know that STT was put in lieu of capital gains. So now capital gains is back, capital gains is being hiked, and STT, I think, has gone through some 3-4 rounds of hikes. So somewhere this expectation got built that the government will do something to make India more competitive on the capital market front. Now, those expectations were not only belied, the fact is that STT has been further increased on FNO, which causes more friction in the markets, right? So I think that is what, and capital market obviously will be preoccupied with capital market related stuff. And then eventually when the dust settles, see, if you look at it, when the budget was announced, market was down nearly 2%. And then it bounced up because if you leave aside all this FNO related stuff and you focus on the real stuff to make India more attractive, right? Which is say tax holiday on data centers for like till 2047, or you look at electronics manufacturing related incentives, or you look at so many safe harbor simplifications for IT enabled services, BPOs and KPOs. So I think overall, I think what happens is that the budget is delivered on many fronts, but market probably wanted to hear infrastructure spend, defense spend, tax cuts, those kinds
Right.
of things. I think that is why market has reacted this way. Eventually, the dust will settle and we will move on.
So you anticipate that this is a temporary negative reaction from the market.
Yeah.
Okay. But coming to the STT also, right? Do you think it's been introduced to de-incentivize trading in India? And do you think that's a good thing?
No, see, I think that it's almost being. I agree with you because it's almost now becoming like as if it is some kind of sin tax, right? And I think that should not be the case. It should be treated on merit. And the merit point out here is that you introduced STT when you removed capital gains tax. So now that capital gains tax is back and back in full force because you've not only brought back capital gains tax, you've increased it also.
Correct.
So purely from a point of principle, we should not be having such high STT. I mean, if you go back to the old story, then we should have removed STT when we brought back capital gains tax. So hiking it is actually even more unfortunate. And I think, treating something, see, it's not that everybody who's doing only speculation is doing FNO. I mean, I know that there is a large population doing FNO speculation, but let's not forget, more than 3 lakh crores of retail investors' money is in arbitrage funds. And arbitrage funds, they use FNO extensively. Our hybrid funds use FNO extensively, and there we are genuinely using it for risk mitigation. So even those returns suffer, right? So clearly, I think it's gone a bit far than what was originally expected, and I think that is what is causing the pain.
Right. You mentioned that probably investors were expecting some cut in LTCG, right? But since there is no LTCG relief and nothing in the budget has given FIIs a reason to come back, when do you think FIIs will come back to India?
So just to clarify, there was some expectation to make India at par with other emerging markets when it comes to taxation for foreigners. Now, I'm not trying to say the answer should have been capital gains. It could have been anything, and STT was one of the things, right? Because see, we ourselves are a very large foreign portfolio investor. We manage almost $1.5 billion in emerging markets all over the world. So our own emerging market funds, when we invest in multiple other countries, multiple other jurisdictions, we don't end up incurring so much tax. But when we invest from those very funds into India, we need to provide for taxes. So definitely India, amongst other markets, sometimes might appear unattractive, and that is what the expectation was, which obviously those expectations have been not only belied, STD has actually gone up. So that is not addressed. Now, coming to your question on FIIs, I think, see, ultimately the point is that people invest for gains. So let us say that if there is XYZ market for which the expected return, like say in India, 32 years history is that nominal GDP growth is 12.5% compounded and our index has compounded 14% in rupee terms. In dollar terms, we have compounded at 10%. Now, if tax was not there, then 10% dollar growth over last 20 years is fantastic. But given that you have 14% long-term capital gains tax, right? Then your level of indifference will not be, so then, instead of 10, you need to better generate some, 11, 12 or something like that, right? So what happens is that when you put taxation, the expected rate of return would go up, and on top of it, the rupee is not stabilizing. So what is happening is we're increasing the number of hurdles to overcome. While India's domestic conditions are improving, growth is likely to go up, and the government is making it attractive as a manufacturing destination and as a IT destination. All that is welcome. But despite all of that, if you have high taxation, then the amount of return that one needs to generate to justify, obviously goes up.
This becomes high. Yeah.
Yeah.
Understood. So coming to sectors, Ashish, which sectors do you think will benefit the most from this budget and which sectors will be affected negatively?
See, I think clearly you can see that in terms of scaling data center investments and what goes ancillary with it. So when you scale data center investment, then obviously energy, power, and a lot of other stuff that goes with it benefits. Second, capex, I mean capital goods equipment and those kinds of things. The second, obviously, is that when you look at the safe harbor rationalizations, then clearly IT, yes, it's just the friction goes down, the predictability of the regime, and how you plan for your taxes and how you treat your expenses. I think all of that gets sorted. Third is that when you look at manufacturing in general, I mean we are doing many things to continue on the right path as far as electronics manufacturing is concerned, and now chemicals, etc., is concerned. So my sense is that, like I said right at the beginning, I think if you purely look at it from capital market perspective, there is some disappointment. And when I said tax comparability, etc. But when you look at core growth in India, from those perspectives, I think it's good.
Got it. And anything in the budget that could give more push to a particular market cap, in your opinion?
Not really, not really. But what happens is that if you look at the broader, see what happens is the way to look at it is that if you look at the large cap index has a preponderance of stuff like oil and gas and large banks and metals and those kinds of things. So whereas on the other hand, clearly when you have a push for manufacturing, when you have a push for ancillary industries, chemicals, for instance, then what happens that the small and mid cap, it enables more scope for stock picking. So any which way, if you see our portfolios, we are heavily into small cap, not because small cap will outperform, but because small cap is the space where there is heterogeneity and there is scope for alpha generation. So my sense is that the budget does open up some of those possibilities.
Understood. One sector that we saw a continued push in is the infra sector, right? What do you think can be the takeaways for investors?
See, I think that, when we look at infrastructure, what we have seen time and again is that the guys who actually make, build, or deliver the infrastructure may or may not necessarily benefit, because ultimately all infrastructure is for public consumption. Right. So in that sense, infrastructure, highly capex, highly capital intensive, can be cyclical. Ultimately, you don't want unlimited gains for infrastructure providers. Correct. So we always try to play that through capital goods and through the providers of capital goods or the ancillary to infrastructure. I think that is a better way to play it. So from that perspective, I think capital goods and ancillary equipment providers, they are the ones which would actually benefit.
Understood. So, in your opinion, Ashish, like, who does this budget clearly prioritize and what seems to be missing from this conversation?
No, see, look at it this way. Typically, when a budget speech is made,
Hmm.
correct, you know that there is long description about rural economy, rural roads, NREGS, right, and the agri economy, correct. But if you heard this budget speech, it kept talking about manufacturing. It kept talking about making it a attractive investment destination purely from business perspective. It spoke about tourism. It spoke about infrastructure and connectivity of various modes of transportation. So look, I think some of these are welcome changes. Of course, the government invests in rural infrastructure and in supporting large part of the economy. But when an entire budget speech focuses on making India attractive for manufacturing, focuses on infrastructure, focuses on stuff like data centers and AI related investment, job creation, upskilling, so all of those are welcome. I don't think it misses anything. That's why I said right at the onset, what happens, all of us are preoccupied with stock markets. And when you see exchanges and broking companies falling 8, 10, 12%, then it clouds people's judgment. But I'm quite sure that's only momentary. Otherwise, the budget made all the right noises.
Understood. So, on a closing note, if you could, highlight maybe one big positive and one big negative from the budget.
See, I think this STT thing is not one big negative, but my point is that if you keep on increasing it, I think that is what I'm more worried about. Look, there was a point in time we had no capital gains tax. But the moment we got 10% capital gains tax, then I could imagine that someday 10 will become 12, 12 will become 15, and it just opens a door and it keeps going. That is what is happening with this whole STT thing, which is that if nothing, it just keeps going up, and that's not good for the market because it increases friction. It makes it, and everybody out here is not. We are not speculators. We are using FNO for the right reasons because we manage arbitrage funds, we manage hybrid funds, all of these, right? So I think that in itself, raising STT in itself is not negative, but what it tells me of how these things are moving, I think that is the real negative, correct? And if you ask me positive, I think I already highlighted to you, which is that it seems to be focused on it seems to be focused on getting capex and getting manufacturing and investment. So I think those are the big positives. And see, there is simplification, safe harbor, reduction of TCS. Now take an example that somebody is sending money for education. The tax collected at source, ultimately, you're going to, for all genuine taxpayers, you're going to just refund it. So why collect, why do you want to collect 10% and 20% and all? Right? TCS is just to keep tab that, okay, the fact that there is a TCS collected means that you have certain income and you have certain foreign expenditure and it should be mapped, right? So the TCS is just a tracking mechanism. So it makes sense to bring it down. I mean, why would you have TCS at that? So I think some of these simplifications are welcome.
Yeah.
It's good. It's a good move.
No, for sure. Any message for, for investors to keep in mind that you would want to leave them with?
Never. I mean, I would say that look, Ultimately, markets are driven by earnings. And in the last 1.5 year, compared to 2024, now that we are in 2026, I think the domestic performance and the earnings trajectory and the economic performance is actually improving and is set to improve. And from that perspective, the budget pushes in the right direction. So don't get caught up with the immediate market reaction. Don't form your opinion based on how the market reacts in the first 1 hour, right? Because market is full of people who are just responding, and then later on people actually analyze. And plus, budget is just one day. All said and done, it is meant to be a statement of the government's accounts. So yeah, and then there are some policy statements. But ultimately, what will matter is earnings, and I think on that we are likely to see improvement in the coming time. I think domestic conditions are improving, but the external environment is causing the upside to be capped. So from tomorrow onwards, people will again get focused on what is happening with US, what is happening with AI companies' results, what is happening in geopolitics. So I think those are the issues which are holding the market. Otherwise, I think domestically our conditions are improving.
So, do you have a positive outlook for 2026?
Frankly, I think 2026 is going to be more of what happened in 2025. I don't see the market going anywhere, at least in the next few months. At least for another couple of quarters, I don't see it going anywhere. I think there is a scope for a correction and then a up move. And like I said a couple of times, nothing to do with domestic markets. I think domestic conditions are improving. But when I say I expect not much to happen, or I expect first a correction and then an up move, that thinking is more driven by what is happening outside rather than our domestic conditions.
Right. Thank you so much, Ashish. This was super helpful. I think this will be very insightful for our audience to understand where the markets are moving, what to expect in 2026. So, thank you so much for your time, and
Thank you.
looking forward to more conversations with you.
Thank you. Thank you.